Hello and welcome to our second quarterly ESG Insights newsletter of 2023. In this edition, we look at why governance is an important aspect of ESG which shouldn't be ignored, particularly in light of recent corporate catastrophes. We examine President Biden's Inflation Reduction Act in the US and its implications for both the UK and Europe. Finally, we discuss conscious quitting and why corporates should pay close attention to the value of their human capital. We start by considering governance, the G in ESG. In recent months, there have been a number of corporate issues which highlight why the importance of having appropriate governance measures in place should not be underestimated. Silicon Valley Bank's high-profile collapse was attributed partly to some fundamental governance failings, having been without a chief risk officer for much of the last year and having been historically warned by Fed regulators that its risk management controls were inadequate. As we enter AGM season, we also examine the concept of overboarding and why there is a fine balance between having plentiful external experience on a corporate board without directors spreading themselves too thinly.
We also take a look at President Biden's Inflation Reduction Act, examine the implications for both the EU and the UK from a corporate sustainability perspective. We are already seeing some impacts of the Act, with corporates feeling the pull of subsidies and making business decisions to relocate projects to the US. In response, research shows that a number of UK business leaders would support a British equivalent in order to level the playing field with our peers both on the continent and across the Atlantic.
In our last ESG Insights newsletter, we explored how corporate culture has jumped up the list of employee priorities. This quarter, we take a deeper look at this theme, in particular looking at conscious quitting, a behaviour coined by Paul Polman to characterise the act of walking away from an employer based on perceived ESG failings. Polman's research shows that employees are increasingly unwilling to compromise on their values and expectations when it comes to choosing who they work for. The link between happy employees and company performance is something that has risen in prominence in recent years, with some investors actively backing companies which pay closer attention to the value of their human capital.
In this edition, we also feature RWS Holdings plc as our client in focus. RWS is a world's leading provider of technology-enabled language, content and intellectual property services, and it approaches ESG through the lens of its four corporate sustainability pillars: people, community, environment and governance. The group takes a highly focused approach to ESG, targeting key areas where its actions can have real impact. It was an early adopter of key industry sustainability reporting measures, including TCFD reporting. As a people-focused business, RWS's materiality assessment concluded that its social impact is of the greatest relevance to the group and its stakeholders. It therefore focuses heavily on both its people and community sustainability pillars, encouraging collaboration and engagement between all its colleagues and partners, and uses its RWS Foundation, a charity that provides ways for donors and volunteers to break down language barriers, to help people around the world to communicate effectively. As always, please do get in touch with the team here at MHP if there's anything we can do to help, or if you would like to discuss any of our thoughts in more detail.